Alright guys, welcome back to our YouTube channel. In today's class, we are going to be looking at business valuation. Before we do that, let's recap what we did in the previous section, which is under the scenario analysis. Now, in the previous class, we talked about the scenario analysis and we looked at how to tie it to our financial statement. And we see that after we have done that, we see how effective it is on that. We see how it affects our financial statement under each case selected. Now, you can see that in the best case, when you select the best case, you can see that everything changes. When you select the base case, which is the current state, everything also changes or comes back to normal. Then we have the worst case. So that is how we tie up our scenario analysis to our income statement, to our financial statement, and still we have our income statement balance. So that is one good thing about building a good financial model or linking your financial statements accurately. Now, in this section, we are going to be talking about business valuation, which is very, very important. Now, but before we do that, in this particular section, what we discussed before we start the calculation, we're going to now understand what business valuation is before we can proceed. Now, business valuation, I am sure we have witnessed a lot of instances where we have what is called merger and acquisition, where a business is trying to merge with another business, just like the Access Bank and the Diamond Bank that merge, right? So these are some of the instances we can find. Now, if you have ever wondered how much a business or how they come about the conclusion and how they come about agreeing to merge, the first thing they did is they evaluate the business, each business, they evaluate the business, and the buying business, the one that is buying the business or the one that is merging with another, we now know the worth of that business before they come together in agreement to become one. So if you have ever wondered how much a company is worth, whether you are a business owner or an investor or just curious, knowing a company's value is actually very important. Now, businesses are valued when they have been sold or bought, or when the investor want to know if they should invest in such company. So in this section, I'm going to explain what company valuation is, why it matters, and the different ways to calculate a company's worth in simple terms for us to understand it better. So why is valuation important? Valuation is important when you're trying to sell a business or buy a business, or when you're trying to attract investors, or even when you're trying to merge with another business, when two or more companies come together as one, or just simply understanding the company's financial health. That's why company valuation is important. So, and also there are things that affects company's value. I'm also going to look into that. So there are several factors to determine how much a company is worth. And the first factor you're going to look at the company's assets and liabilities, and that is what the company owns and what it owes. So that's another way. I also look at the revenue and the profit. That is how much money the company makes and how much money it keeps. Yeah, the company may make higher revenue, it will make enough money to say, but at the end of the day, you realize that the company is not making any profit. Why? Maybe due to some reckless spending, something like that. We have seen instances like that. Okay, so we're also going to look at the industry trends. So when you're trying to value a business, you have to look at these areas, what affects the business. So like I say, you're going to look at as a corporate financial analyst, you're going to look at the assets and the liabilities of the company, and you're also going to look at the revenue and the profit of the business, and look into also the industry trends. Now, why we are looking into the industry trend is to understand, is this industry growing? There may be money in that industry. Yes, there may be money in the business, but if the industry is not growing, it actually will not make any sense. So it's also very important. They will now look at the market demand. So when we're talking about the market demand, now we're talking about how many people are fighting to buy this same company that we are trying to buy, or how many people are willing to invest in this company. So if the market demand is high, that means the value of the business also will be high. Now we also look at the risk factor. So the risk factor is talking about how risky is the business. If the business is too risky, its value may be lower, right? The value may be lower. So that is it. There are basically 3 methods of valuing a company, but we are most interested in the third one. But for learning purposes, I'm going to just skim through them so that we can just understand them in our own leisure time. We do further research on that. But what is most important to me is the third one, because that is the one that affects what we are trying to do, right? And I'll tell you why later. Now, method of valuing a business or a company, we have one, the asset-based valuation. Now, this method looks at what the company owes, and there are 2 common ways to do that. Now, it looks at the book value of those assets, then less their liabilities. This is found on the company's balance sheet. Of course, if you want to know the book value of every transaction in the company, now look at the company's asset position at the end of the period, which is found in their statement of financial position or balance sheet, right? Now look at the liquidity value of that asset, of that company. How much the company will get if it sold everything today. So how much will you make from that company if they sold immediately or if they sold today? So that's the liquidity value of that company. Now let's say for instance, we have a company, a business is valued at let's say 100 million naira, right? Let's say a business is valued at 100 million naira or 1 million naira or 1 million naira. Let's say that. I'm just trying to give us instance. We have not started. I'm just trying to explain what valuation is and to throw some light. Let's say the business is valued at 1 million naira, and this 1 million naira is a total asset base. That's the asset base, right? Asset base, and we have a 300,000 naira liability. So we have 300,000 naira liability. So what it automatically means is that the value of this company is equals to this 1 million naira minus 300,000, which is now going to give us 700,000 naira. So this is now the value of this business. That's the value of the business. So the value of this business is now 700,000 naira, right? So that is it. That was a simple way to understand the asset-based valuation method. Now the second method of valuation is now the market-based valuation. So the market-based valuation compares the company to similar businesses or similar companies that were recently sold in the same industry, right? And that's the market-based valuation. So what it means is that we are comparing the company with another. So we look at how much similar company or similar business in the industry are worth. And let's say if we have a business in the hospitality industry, let's say restaurants for instance, and there's another restaurant that was recently sold. So we're not going to look at the value of that business, that restaurant that was sold. The restaurant, let's say the restaurant A and the restaurant B. So we're not going to look at the value of the restaurant A that was sold to our own value. So we are going to likely assume that our business is also worth that amount, right? That is what market-based valuation looks into. We have what is called the precedent transactions. Uses this as sales of similar companies to estimate the value. Like let's say for instance, like I said, if company A sold for let's say 5 million naira, and our own company we're trying to value our own company, that means we are likely going to say that our own business too, because we're in the same area, we're in the same business, we can say that, okay, our own business should be valued at the same 5 million naira. So that is what market-based valuation is talking about. And that, so now the third one, which is actually the one we're going to dwell most on, the income-based valuation, right? The income-based valuation is where we're going to talk about the DCF valuation. So I will tell you why we are going to talk about the DCF valuation much later or shortly. So this method looks at how much money the company is expected to make in the future, right? It looks at how much money the company is expected to make in the future. So, and in this method, this is where we have the discounted cash flow, that's the DCF valuation method, and also have the earnings multiplier. So if we now talk about the DCF valuation now, under the DCF valuation method, we are trying to estimate and say, okay, we estimate that the future profit and we calculate, that is, we estimate the future profit and we calculate their values. And this is why in a startup, we don't, this is why we are going to use DCF valuation to value our business, which is now the DCF valuation method among all these methods. That's why we are using it. So because our company is a new company, it's a startup company, it doesn't have any financial standing yet, it doesn't have any financial history or any transaction yet. So what we are going to do is to predict the future values of the company. We cannot say we want to use comparable company analysis to evaluate our business. Why? Because we as a startup, we don't have any financial standing, we don't have any financial bearing yet, so we cannot compare what we don't have with companies that are already been in existence for years. So what we do, we predict the future value of the business. And you know, startup businesses are more riskier than already existing business because you don't know what will happen in the future, whether the business will succeed or the business will go out of operation. So that is why we're going to be using the DCF valuation under the startup. So we don't use comparable business analysis to value a startup company, right? So another instance again is under the income-based valuation. We say the earnings multiplier. Now the earning multiplier uses the company's earnings and multiplies them by a standard number used in the industry. That is, you have a standard number used in the industry. So let's say a company is valued. Let's say a company is valued. The value of the company. A company is valued at let's say 200,000. Let's say 200,000, and the multiplier effect. So the multiplier is now, let's say the multiplier is 5,000. The multiplier is 5. Let's say the multiplier is 5. So what it means is that I'm going to say the multiplier effect is going to be this 2,000 times 5, right? And this 2,000 times 5 is going to give you 1,000. It's going to give you 1,000 or 1 million naira. So at the end of the day, you can deduce that the value of this company using the multiplier effect is 1 million naira, right? Because we're using the multiplier effect. The multiplier effect uses a company's earning and multiplies them by a standard number used in that industry, which is what we have here. So we assume that the standard number or the standard multiplier effect in that industry is 5, and the company earns 200,000 per year or per month, whatever. So the company value is 2,000, so 200,000. So when you multiply the 200,000 times 5, it's now going to give you the company's value. Let's take it down again so that we can understand what it means better. Now let's look at it in another dimension, right? Let's look at it in another dimension. So let's say we are valuing a small business that is into restaurant again, and we're going to use the asset base. We're going to put all these scenarios in place. We're going to use the asset base. Let's say the company is valued using the asset base ABV. The company is valued at, let's say, 500,000 naira, right? And the 500,000 naira in equipment, right, which is the asset base, and it has a debt of, let's say, 100,000. So we'll try to just put this in effect, a debt of 100,000. So what is now going to be the value of this business? Now the value of the business is going to now be equals to the total asset base minus its debt, which is going to give you the total value of the business, right? So now this is the total value of the business when we are using asset-based valuation, right? Now let's look at another instance using the market-based. We're talking about the market-based valuation. We're saying, okay, business, where a similar restaurant in the industry was sold for 600,000 naira, right? So that means we estimate that, okay, our own business too, using the same method, is going to be valued at this 600,000 naira. It's going to be valued at this 600,000. And that is, we estimate that our own business too, because we are in the same industry, our own business too is going to be valued at this 600,000. Then what happens in the case of income-based valuation methods, right? Now, in this case, we are going to now use the multiplier. So let's say we are using the multiplier effect. So we're going to say, using the multiplier, the income-based valuation method, right? So using the income-based valuation method. So a similar business, like we say, a restaurant, that's the business earns, let's say it earns 100,000 every year or every month, right? And the multiplier effect, let's say is 4, right? Let's say the multiplier effect is 4. So what you're going to do under the income-based valuation method is to using the earning multipliers, right? We are now using the earning multiplier. So the earning multiplier is now 4. Let me spell this out. The earning multiplier, right? The earning multiplier is now 4. So we're now going to say the earnings of the company multiplied by 4. That's times 4. This 4, which is the industrial standard, is now going to give us 400,000 naira. Now, one thing corporate financial analysts do is they don't just assume or make decision based on one, or use one method to make their decision or use their final decision. What they use it, examine the whole process, right? And they look into the whole thing. So with these scenarios we have presented, so it is likely that the value of this business is 600,000 naira, which is dependent on the method used, right? So we can choose to say, okay, the value of this method, the company is 600,000, or the value of the company is 400,000 naira, right? So depending on the method used. And again, you have to know that valuing a company depends on the formula, depends on the method used, and there is no static method of valuing a company. Okay, there's no static method of valuing, depending on the conditions or the situations you find yourself, or the reason why you're conducting that valuation. So you can choose to use any of the valuation method, right? In the next section, we are going to now look into DCF valuation properly, because that is the one that affects what we're trying to do. So which is under the earning-based valuation. So when we come back in the next section, we are going to look into the DCF valuation method. So thank you again, and like I always say, this is the right time for you to subscribe to this channel if you have not, because when we come back, we will dive right into the calculations and to fill out this information here. So let's go ahead and clean this up. If you find this YouTube helpful, please don't forget to like, share and subscribe to Business Hub. So when we come back, we'll now look into DCF analysis.